Welcome back, everyone. Our last speaker is Judith Vereen, who joined New York Life in 2005 after a career in financial services. Judy was driven by a personal mission to help people do what is right for themselves, their families, and their communities by taking charge of their financial futures. Judy's core business is working with clients at all stages of life, retirement and estate planning, including small business owners, through financial services, annuities, and life insurance policies. Her presentation will focus on how life insurance integrates into your financial and estate plans. She will describe the difference between the various types of life insurance, as well as the pros and cons of owning temporary versus permanent insurance. So please join me in welcoming Judy.
Okay, thank you, everyone. I'm glad to be here today. We're going to be talking about protection for the unexpected. And I think we all agree that the last 2 to 2.5 years have been totally unexpected. So, life insurance, why now? Let's talk about that. In a study done in 2021, 42% of those who tested positive for COVID-19 said that they were likely to purchase life insurance. Even millennials say that they're likely to buy life insurance due to COVID-19, and 41 million consumers say that they don't have coverage but need coverage, and that's an increase of 16% from the prior year in 2020. There are a lot of ways that any of us can purchase life insurance. You can get it online. You can get it over the television. You can get it through the mail, apply through the mail. But how do you know that the amount and type of insurance that you have is what your family needs? So we work with clients to understand what those needs are and choose the right amount and type of insurance to fit their family's needs. Today, we're going to answer 4 questions regarding life insurance. Why do I need life insurance? How much life insurance do I need? What kind of life insurance to buy? And why New York Life? So let's talk first about why do I need life insurance? When you're looking at your family's overall financial strategy, life insurance fits at the very base, the foundation of that strategy. So looking at this graphic, you'll see that life insurance is part of that financial foundation. It's going to help you protect what you own, what you earn, and what you owe. It's there for those that you love. From that foundation, you can prepare to accumulate funds for major purchases, emergencies, college education, of course, retirement planning. That will also allow you to prioritize your goals, such as how to diversify your risk and maximize qualified plan contributions and handle inflation. As you're going through that process of accumulating those assets, you want to pass those along. So that's where estate planning comes in. How do you pass along those assets in the most efficient way possible? Many people obviously have charitable giving initiatives and thoughts as well. So how do you put those plans in place? And certainly if you have a business, you want to continue that business as after your passing. So life insurance fits in all of those dynamics of our financial strategy. Life insurance helps protect your family's standard of living. There are, in this case, let's look at 5 standards of living, all the way from luxury to comfort to a charity level. Most of us would probably say that we're in that comfort level of a standard of living, and that's going to be supported by our assets and income. But what happens when your income goes away? That's where life insurance comes in and can be a buffer to help your family continue their standard of living. So how much life insurance do I need? And let's look at it this way. We'll put some numbers around it. In this case, the current income of this client is $125,000. And they say that that income, they could live off of $100,000 of that income from the main breadwinner if something were to happen. They believe that they can get a rate of return of about 4% of those assets. So that means that the survivor will need $2.5 million of investable assets to provide $100,000 of income. And we call that living off the gain. So that would be a capital needs analysis. Again, one of the approaches that we use. The other one, another approach would be to ensure your future earnings value. Think of all the things that we typically insure, like our cars and our homes. If you had a total loss of either one of those, what would you do? If you had a beautiful car that was damaged in an accident and deemed a total loss, would you replace that with a rusty used car? Probably not. If your beautiful home, which is certainly insured, were a total loss, would you replace that with a tent? Probably not. The same should be said for our income, our earnings. That's our contribution, of course, to our families. So let's take a 45-year-old who's earning $50,000. That person will earn over the next 22 years, between age 45 and 67, in this example, $1.1 million. That's that person's future earnings value. If they were earning $100,000, that future earnings value would be $2.2 million. Again, that's another approach to determining how much life insurance you need. Another approach would be looking at a survivor needs analysis. So in this case, we would work with our clients and identify what are your immediate cash value needs. That certainly would include final expenses, a mortgage or a rent payment fund, college education, charitable giving initiatives. We'd add all of those categories up, come up with a subtotal, subtract out any cash or other liquid assets, and subtract out any existing life insurance. That brings us to a total cash needs immediately, what this family wants to make sure they have funds in place for. Then we would add to that ongoing income needs as well. Some other considerations in terms of how much life insurance do you need would be answering this question. Do you currently have benefits at work? Can you take those benefits with you if you leave your job or retire from that job? And can you take those benefits, that insurance coverage, with you at the same cost? Is your investment portfolio down? What are your financial goals, again, for the next generation, for charitable giving? And do you have any concerns over final expenses? So what kind of life insurance to buy? There are two basic types of life insurance. I like to summarize it and maybe simplify it by describing it this way. Renting versus owning. Term insurance is temporary, like renting an apartment. A permanent cash value policy is similar to owning a home, and we'll talk about those a little bit more here. So if you have a term insurance policy, it certainly will pay a death benefit as long as that premium is paid. It is protection for critical periods of time. It can be a very economical way to just make sure that there's some coverage in place for your family, but it will be the more costly of these approaches as you continue to live. It does not build cash value. But a term policy can be a rent to own scenario, meaning that you can initially get a term policy and then upgrade it or convert it to a permanent policy down the road within some parameters that every company sets. Owning a policy would be having a permanent cash value policy. It certainly will provide a death benefit as long as the premiums are paid. It is a permanent solution. It will be there for your whole lifetime. It may be more costly than term insurance in the beginning, but it will be the most affordable type of insurance in the long run. It builds cash value, and a portion of what you pay for your premium goes towards building that cash value as well. And the cash can be borrowed against. So, what type of life insurance to buy? Use term insurance. If you are looking for temporary protection and affordable premiums and the ability to upgrade or convert that to a permanent plan, life insurance through a term policy, the paying beneficiaries will be tax-free to your beneficiaries. And in addition, if you have a term policy, it allows you some flexibility to perhaps combine different durations of term policies. So for example, if you need a 10-year term to cover your children's education in the next 10 years, that can be combined with a 20-year term that may make sure that your mortgage is covered in the event something happens to either spouse. Let's look at term insurance. As you can see in this chart, it can be a very cost-efficient way to make sure that coverage is in place for your family. This happens to be premiums for a $1 million 10-year term policy. We'll take that same 45-year-old. A male would pay about $69 a month and a female $55. So you can see it can be very affordable. This graphic just describes how term premiums are designed. So let's look at the top line, a fixed period term, similar to that 10-year term or 20-year term that I just talked about. Your premiums are going to stay the same for that period of time and then start going up. A yearly convertible term can be even more affordable. The premium is even lower, but your premiums are going to go up every year. And again, choosing which one of these is right for your family is part of our discussion with you. Each one of these is designed to get more expensive as we get older. Let's compare that to a permanent cash value policy. And that would be a type of plan similar to a mortgage where your premium is going to stay the same forever. Yes, it will be initially more expensive, but it will not increase over time as we get older. Another type of Another type of life insurance, Another type of life insurance which is available is a universal life. So consider universal life if you want some flexibility. A fixed universal life, the cash value will grow based on an interest rate. It can be designed to provide a lifetime of protection, and the premiums can be very affordable. You also have some flexibility to adjust the amount of insurance that's in place as well as your premiums. So a universal gives you some flexibility. The tax advantages are still the same, a tax-free death benefit to our beneficiaries and tax-deferred cash value growth. Another type of universal policy that is available is a variable universal policy. So if you are okay with being in the markets, a variable universal policy allows you to exposure to the market, and that would be based, your selection of investment options would be based on your risk tolerance and your investor profile. Consider whole life insurance if you want guarantees. Guaranteed protection for life guaranteed cash value growth, and guaranteed that the premiums will never increase. In addition, whole life insurance through New York Life allows you to have a policy that will receive dividends when the company declares dividends as well. The tax advantages in a whole life policy are the same: tax-free death benefit to our beneficiaries, tax-free access to the cash while you're living, as well as an ability to have that a guaranteed protection for life. So this wheel of benefits just gives you an idea of all of those attributes of whole life insurance and the guarantees that we just spoke about. Let's look at dividends. Dividends from New York Life have been paid continuously since 1865. When dividends are declared by the company, there are 4 ways that you can use them. First would be paid up additions, where those dividends buy more insurance. That insurance has a cash value to it, and you don't have to go through any additional underwriting. So dividends that are used to purchase paid up additions are a way to increase the face amount of your coverage, as well as the cash value in your coverage. Secondly, dividends can be used to pay a portion of your premiums. You can also receive the dividends as cash. And last, you can have the dividends just be left on deposit with New York Life and earn an interest rate. Some of you may have heard of a concept called bank on your life or bank on whole life, because there are some additional benefits in a whole life policy because of the availability of the cash that can be used as a loan option against the policy. So what might somebody need the money for? Emergency funding might be one example. Education funding, certainly. A major purchase, such as buying a business or expanding your business. Having a home, purchasing a home improvements, as well as certainly retirement planning are some of the ways that a loan can be used against a whole life policy. Let's talk about retirement strategy, because one of the benefits of having a cash value permanent policy is tax diversification. So when you tax diversify your retirement income, there are 2 ways to handle a situation like that when someone is trying to tax diversify retirement income. On the far left-hand side is a situation where this policy owner just needs $100,000 and wants retirement income of $100,000. Without diversification, they may choose to get the funds this way. Taking $100,000 from a qualified plan like a full 401k, a 403b, a TSP, those are all qualified plans. So when the money comes out, it's all taxable. If that person's in a 22% tax bracket, that is a $22,000 tax amount that obviously would have to be paid. And that gives the person $78,000 to spend after taxes. Another approach would be using a tax diversification strategy. So that same $100,000 is deeded, but now it comes out of 2 sources. $50,000 would still come out of a qualified plan, like a 401k, 403b, or TSP, and it's still all going to be taxable, but that $50,000 is now taxed at 12%. So $6,000 is paid out in taxes. The other $50,000 in the far right-hand side here, it comes out of a cash value life insurance plan. There are no taxes due on that $50,000, so no taxes are due, which means that using this strategy, the policy owner now has access to $94,000 of income and to spend rather than $78,000. So there are additional benefits of using whole life insurance for children's policies even. The same benefits that are available to adults in whole life policies are certainly available to children. So in a child policy, you're providing future benefits to that child. When they're young, the cost never changes. As we said many slides ago, that premium still never goes up for the child. As long as the premiums are paid, that benefit is going to be in place for the child. It's a gift that will never wear out. It can never be outgrown. It will last a whole lifetime. And the guarantees that I mentioned earlier in a whole life policy are not affected by the economic environment. It won't lose value. The guarantees that are inherent in a whole life policy means that your life insurance will increase in value, and the protection value and security that is available for an adult certainly are available for children and will last a whole lifetime. So it's the gift that keeps on giving. Why New York Life? New York Life has been in business and founded since 1845. It is a mutual company, making it the oldest mutual life insurance company in the United States. When the company declares dividends and pays dividends, as they've done consistently for 160 years, those dividends are attributed back to policy owners. As career agents, we work with our clients to develop plans that meet your goals, and we look forward to doing that. I've been a New York Life agent for 18 years, but more importantly, a New York Life policy owner for 30 years. So I'm glad to say that the company has the highest financial ratings of any insurance companies, and that means a lot as a policy owner and also as an agent. Patty, thank you very much. I'm ready for questions.
Okay, here's our first question. And it is, what is your opinion about employer-sponsored life insurance?
Great question. I think it's great. We actually help employers put that kind of insurance in place as well. I think it is great. It doesn't usually cost a lot because it is through your employer. But going back to that slide a few slides ago, the question is, what happens when you leave? Does it stay with you? Usually not, and usually not at the same cost. But it doesn't cost a lot while you are at that employer. So I think it's great. I think everyone should have it. And it will pay out usually the same way as a tax-free benefit to your beneficiaries. It's usually a term policy. So just some things to be aware of, but I think it's very important to have it for the safety of your family.
Okay. And, I know, Judy, in the previous session, Cheryl had talked about the life insurance policy that's convertible to long-term care.
Oh,
Does New York Life offer such a policy? And if you could maybe talk about that a little bit.
Oh, great. Yes, absolutely. Absolutely. New York Life does offer that. We call it a linked benefit or hybrid. Think of like a hybrid car. So I believe in my opinion, I believe it's because the baby boomers, of which there are many, have kind of changed how they approach long-term care insurance. Initially, long-term care insurance was set up just like all of the other insurances that we there, then I'm going to use it. But as the industry has expanded and baby boomers have grown in numbers, there's now more of a focus on, suppose I never need the long-term care, but then what happens to it? So there are policies out there that certainly are available as built on a life insurance chassis, if you will. But and there for the benefit of long-term care, but if I don't need it for long-term care, then it's still going to be an amount that passes to my beneficiaries tax-free. I get the money tax-free while I'm living because it's built on that life insurance chassis to use for my own chronic care needs at that time. But then if I don't use it, it passes on to my beneficiaries tax-free as a life insurance benefit. So absolutely, we do that. There are a lot of ways you can pay for it, a single sum over a certain number of years. So those are certainly available.
Great. So the next question is, can you please explain the differences between term and life at end of life? And in other words, when one spouse dies, is there a difference in what happens between the two types?
I see. So most term insurance with 99.9, probably 100% of all the carriers there, term insurance will end at a certain point. Most term insurance policies are designed to end at age 80, 85, or 90, versus any of the permanent plans that we talked about. Believe it or not, when we do those illustrations and those numbers, the coverage lasts until age 121. Don't think many of us will outlive that. Maybe our children will. So really what you want to be aware of is if you're looking at a term policy, it's very affordable, as I showed you there, particularly in the beginning years, but it does usually end. And when it ends, it's over. There is no benefit that is available to your family. On the other hand, that those permanent policies are designed, again, to last until age 100 or 121. It will be there for your family for literally your whole life.
Great. And then what type of policy would you recommend for elders who are age 70 and older?
Well, I think a permanent plan is certainly one. When any of us gets to be a certain age, term insurance throughout the industry, the options narrow down. And again, as you remember that mortality chart, it's literally because of that. The cost becomes so cost prohibitive. So usually for someone 70 and older, we look at a permanent solution. Maybe it's something that'll address their needs for final expenses. It can be any of the permanent types of policies because we want to make sure that the premiums stay the same usually and that the coverage is going to be there as long as necessary. So by that measure, it is a permanent solution and not a term solution.
Okay. And the next question is, what is better for a 50-plus-year-old, whole life or term life insurance?
It depends. Certainly at 50, if you, depending again on what your goals are, if you're trying to cover I like to try to describe it this way. If you're trying to cover a temporary need, again, let's think of like a mortgage payment or something, then maybe, again, having a term insurance policy to match that period of time would make sense. But you just have to realize that after that term period ends, it becomes more expensive. So sometimes, as I was mentioning earlier, we can combine plans and customize plans that work for your family. It might be a combination of term just to make sure the amount of coverage is in place, but know that at 50, as we get older, again, based on that mortality chart, it's going to get more expensive. So we might look at putting at least an additional permanent policy in place, making sure that that meets your needs and your budget. So it might very well be a combination, depending on, again, what are your goals and what are your budgets, and what is your budget in that case.
Thank you. And can you comment about burial insurance?
Yes, burial insurance is a final expense insurance. They usually are designed to be whole life policies, again, because many people who buy those are older, totally makes sense, as I said before, about the 50-year-old or even the 70-year-old. So a burial policy is a whole life policy usually. It's there, the price usually stays the same until for the rest of that person's life. It will pay out in the event of the person's death. Sometimes you can design a policy so that the beneficiary is your family, or it can be just the beneficiary can be designated as the funeral home. Again, that can be worked out with the person. And burial policies tend to be smaller in size. So you might find burial policies of 15,000, 20, 25,000. And sometimes they have limited or no underwriting, which means that if it's a guaranteed issue, not to get into the weeds here, but if it's a guaranteed issue policy, then there may be a waiting period before the full benefits are paid out. And I can talk with anyone one-on-one about that. So burial policy certainly meet that need, but you just have to understand how they work and who they're paid out to and the amount that's available. All that has to be taken into consideration.
Okay, great. And then if you pass away, how does your life insurance policy, and this is a permanent policy person is asking about, how would that policy pay out to your under age 18 child?
Yes, great point. Since March of 2020, well, let me answer the question first. It pays out to a child in the same way any of the other benefits are paid out. So I'm going to back up a little bit again. Claims, meaning that claims are paid out within 3 days if the policy is under $100,000. So if the policy is under $100,000, that claim is paid out in 3 days. They call it an express claim in the claims department. Over $100,000, usually the payout is within 7 to 10 days. So you can see how life insurance is a way that quickly a family can get access to funds to meet all those needs that we talked about earlier. Now, if we have a person, you can certainly, with minor children, certainly understand that. But remember that the age of majority in this tri-state area anyway, in most states, I believe, is over 18. 18 or over is the age of majority. So you would want to name a custodian that would take control of those funds for the benefit of the minor child. The child can inherit it, but that custodian has to go to a bank, set up a custodial account, etc. So if you are naming a minor child, we encourage everybody to at least name a custodian. Absent that, funds can be held on deposit with any company, like with New York Life, until the child reaches 18. That's another option. I had someone just last week who said that's what they want to do. They didn't have a custodian who they wanted to name. So there are a lot of ways to handle that, but I think it's really important that you name a custodian, because the insurance company will pay out exactly as the beneficiaries are listed.
Okay. And the next question is, can we purchase insurance for college age students or are young adults just starting out in the working world for investing purposes? Or would it be best for them to take it out themselves because the premium might be lower?
Well, let me explain one thing that I was hearing. Anyone who owns the policy controls the policies. So when I told my son when he was in college that we had policies for him and he's with cash, and he said, "What do you mean? I can use it? I can cash it in?" So until you know that child is not going to totally cash it in, you really might want to be the owner of that policy. So that is very common that parents will own policies on children. We usually set it up so that another parent, depending on the age of the child, another parent is the successor owner. I'm sorry if I'm getting a little technical here, but again, the ownership is going to remain with the adults. And then eventually the ownership certainly can be turned over to the child when you think they will be able to take over the payments and hopefully maintain it. But if you do turn the ownership over to a child at any age, over 18, they can certainly cash the policy in. There are strategies now where you can set up a policy so that cash can accumulate quickly, and particularly for children, so that you pay into it for 10 years, let's say. Either you're in the market or not in the market. You're sort of fast funding it, maximally funding it, but it's going to be paid for in a limited amount of time, 10 years, 15 years, something like that, in the market, out of the market. So again, those can be designed, but it totally makes sense to get insurance on our children, even though they become adults. But the cost, it stays the same, and it's usually less expensive. And we're all usually healthier when we're younger. So it makes a lot of sense to put those kind of strategies in place.
Great. And is there any benefit or difference between having a term life policy or investing those payments into a 401k?
Well, I think the first difference that comes to mind is the tax treatment of the funds. Your term policy is one, of course, that doesn't have any cash value. Any money that goes into your 401k, remember, is going to come out tax-free. I'm sorry, any money that goes into your 401k is going to come out taxable. That was the page that we looked at a little bit earlier. Another approach that might make some sense could be to have your cake and eat it too. Have a variable universal policy where you're still, purchasing life insurance on yourself. You're still in the market with, any bond or mutual funds that are, that meet your need and meet your investor profile. But now when the money comes out of that variable universal policy, it's coming out tax-free. So you're still in the market on both of those, in both of those strategies, but one approach, the money is going to be taxable. The other approach, the money is going to come out tax-free. So that's another way that perhaps might work for that person.
And is there a limit on the number of policies a person can have?
The limit not on the number of policies generally. When we are taking information in an application and giving that to the underwriters, there are some financial questions. So an underwriter will ask, about your income, your assets, because there is a financial component of underwriting as well. But and the underwriters do ask for, any company will ask what other coverage you have in place. So it all has to be reasonable in terms of what the amount of insurance that you're asking to purchase and what you have in place already. And again, I'm kind of going back in my mind on that earnings chart. And you can see that a 45-year-old person earning $100,000, that's over $2 million. And of course, it varies depending on our age and income and that kind of thing. But there's not a limit on the number of policies. I would say the limit is more on the amount of insurance that you have on yourself. So think about, what are you trying to cover, and what are you asking what amount are you asking for in additional coverage?
Okay. The next question is slightly related, but the participant has a long-term care policy, but no life insurance. So how does that long-term care policy with another company affect premiums and payouts?
Well, if you have long-term care at another company, you probably got that when you were much younger. So you'll want to look at the whole long-term care policy, understand what those benefits are. It doesn't mean that you can't have another life insurance policy. If you don't have a life insurance policy, you certainly want that in place. So long-term care is going to pay out when we have a long-term care need. So think of it this way. When we lose 2 out of 6 activities of daily living, again, I try to simplify things. So think of all the things that you did this morning when you woke up. You got up, we all went to the bathroom, you bathed, you ate, you took your medications, etc. So those are called activities of daily living. There are 6 of them. Or you have a cognitive impairment. So long-term care and those conditions are expected to last 90 days or longer. Sorry for the long definition. But a long-term care policy is going to pay someone to come into your home or for you to have to go to a facility like an assisted living facility or nursing home or an adult daycare. There are policies now certainly that pay for that. So that would be someone giving hands-on or standby assistance during your lifetime. Unless you have one of the hybrids where it's going to pay out some amount to your family for a life insurance need, your long-term care is going to just pay for long-term care needs. Therefore, having some amount of insurance in place for yourself is what is going to allow you to have money available to pay your beneficiaries. Again, on a tax-free basis if it's life insurance. So 2 different needs and 2 different solutions in terms of what I'm hearing from that participant. So thank you for the question, though.
Okay. The next question is, can one still purchase a permanent policy using a lump sum payment? And this was an option some years ago, and the participant is asking if this option is still available.
Patty, can you just repeat the very last part of that? If they're using what?
Can the participant purchase a permanent policy with a lump sum payment?
Yes, that's possible. Yes, that is absolutely something that's possible. And I'll just leave it at that because there are a lot of ways that we can help you put a plan like that in place and have that lump sum help you fund your policy. So absolutely, that's very common now.
Okay. And is it difficult for someone who is around the age bracket of 50, but who has chronic health problems to obtain term or permanent insurance?
Yes. When all of us, when we're looking at life insurance and we go through what we describe as full underwriting, we're going to be asked our medical history. Usually it's a 10-year medical history. Usually that means getting medical records, etc. Every company underwrites differently, but you generally have to be in good health enough for that underwriter to say yes. So I like to think of it again, if I have car insurance and I get in an accident this afternoon, I can't call my insurance company or any insurance company and say, oh, can you now insure me? So when we're looking at someone who has some health conditions, then we will look at a couple of things. We'll look at maybe a guaranteed issue where, again, there are no health questions, but we explain very clearly how that guaranteed issue policy works. That's one option. And then sometimes even something like annuities might work because those are, again, funds that are going to be paid out to our beneficiaries, but there are no health questions. So there are a number of solutions that might work. So I think that I would tell that 50-year-old person with some health conditions, certainly let's talk and see what those options are. And it might is something that ultimately is insurable. So we'd need to know a little bit more.
Okay, great. And is it possible to move a work policy to a private policy?
It depends. It depends. Usually, though, what I would say is what we would be trying to do is just match the coverage. Let's say you have, I'll just choose 100,000. Maybe it's your salary plus a multiple, or you have $100,000 at your job. Then, because that's term insurance, it doesn't have any kind of value that can be transferred over to a permanent policy. But what we may end up doing is saying, okay, keep your $100,000 at your job until we get a private $100,000 policy in place. Again, it usually doesn't cost a lot. You may not be able to keep it when you leave, but there's some coverage there for your family until we can get a new policy in place. So you wouldn't really be able to transfer it. What we would be able to do is match the amounts usually.
Okay, and for a life insurance policy with a cash value, is it better to withdraw the cash from the cash value or a loan?
I hate to say it depends, but it does. So let me try to explain that, because we actually have that often, and particularly during the pandemic that we've all been dealing with for the past 2.5 years. With New York Life, and I just had this conversation with someone yesterday. So if you take out the dividends in the policy, those dividends come out, you use the money however you want, but it does reduce any of the growth that you've had in the policy from those paid up additions. So everything's sort of tying back together. And you can't pay the dividends back. So if you had $10,000 of dividends, you just take them out, use that $10,000 for whatever you want, but it will reduce any growth that $10,000 has added to your policy. On the other hand, a loan is available as well. You can take out, probably 99.9% of your value as a loan as well, but you can repay the loan back. So when you repay the loan back, you are restoring the values in your policy. So again, it sort of depends on what you're trying to do, but those are options of accessing the values in your policy.
So thank you, Judy, for your presentation and for answering all those questions so thoroughly. We really appreciate your participation.